Welcome to our monthly webinar series here at Personal Wealth Strategies. Today, we have a very special guest that's not so much a guest because he is the founder here at Personal Wealth Strategies. So we'll wait as people start to get in, and most of you should know David, but I will still give him the honor of the introduction so that we can make sure if you're watching this on the replay and you don't know David, that you know who he is. Very great background. So please welcome David Bailin. He is the founder of Personal Wealth Strategies, and he's also a distinguished speaker in the field of finance as well. A very strong focus on helping successful individuals and their families accumulate and preserve wealth. He established Personal Wealth Strategies back in 1996 as a passionate student of financial research. So all of our investment knowledge is based on Nobel Prize winning principles of modern portfolio theory. And his expertise is backed by extensive background of education, starting with Lehigh University, then getting his accredited investment fiduciary designation, chartered financial consultant, chartered life underwriter, and additionally his certification in long-term care. So without any further ado, I will introduce David to present on the topic of to Roth or not to Roth. That, of course, is the question. So David, welcome and take it away.
Well, thank you very much, Justin. And yes, you've hit it right. Today's topic is to Roth or not to Roth. And let me just make sure I'm sharing my screen here correctly. All right. So we're going to start off by asking the question, as you might imply from the title, what if William Shakespeare had a 401k plan? We think Hamlet might have sounded a little bit like this.
To Roth or not to Roth, that is the question, whether 'tis nobler in the mind to suffer the slings and arrows of outrageous taxes, or to take arms against a sea of troubles, and by opposing them, end them.
Good morrow, Hamlet. What ails thee so? Why dost thou look so glum and low?
Ah, Polonius, my mind is troubled so. To Roth or not to Roth, I cannot know. The tax implications make me fear that in the end, I'll lose all that I hold dear.
Ah, Roth IRAs, I see. A wise choice, if you ask me. But let me explain the benefits and drawbacks so that you may make an informed decision without any shocks. Here's a list of benefits forsooth. Firstly, tax-free withdrawals in your youth. Secondly, no mandatory distributions are there. And thirdly, a legacy to your heirs is fair. But there are drawbacks to this plan, to which you must pay attention, of course, if you can. Firstly, taxes must be paid up front. And secondly, eligibility rules must not be swayed.
I see, this is very wise. But I must ponder further to my surprise. For taxes and investments are not easy things. I must consult my mind and other learned beings.
Indeed, young Hamlet, take your time, for this decision is not one to be made in the prime. Consider your goals, your income, and your age, and with these factors, make a decision, sage.
To Roth or not to Roth, that is the question. The benefits are many, the drawbacks few. But can I pay the taxes that are due? And will my eligibility last until my pension?
Good morrow, Hamlet. What troubles you so? Why does thou look so glum and low?
Ah, Ophelia, my mind is troubled so. To Roth or not to Roth, I cannot know. The benefits are many, the drawbacks few. But can I pay the taxes that are due? And will my eligibility last until my pension?
Oh, Hamlet, let me help you so. For I have heard of a way to make it glow. A backdoor Roth IRA, they call it. With it, taxes can be avoided a bit.
A backdoor Roth IRA? What is that? I have not heard of it. Tell me flat.
It is a way to contribute to a Roth IRA, even if your income is above the limit, they say. First, you contribute to a traditional IRA. and then you convert it to a Roth IRA.
Ah, I see, I see. This is very wise. But I must ponder further, to my surprise. For taxes and investments are not easy things. I must consult my mind and other learned beings.
So my thank yous to the Personal Wealth Strategies Shakespearean players. You may have recognized Ian and Justin and Denise in that show. And a thank you to Nancy, who put together all the costumes. Now, that could be the very first time that I actually understood Shakespeare. But I understand not everybody on the webinar here is as versed in finance. So let me take you through the differences between traditional and Roth. And for the purposes of today's discussion, when I talk about traditional and Roth, I'm talking about all retirement plans, meaning employer-sponsored plans as well as individual plans. If there's a difference between them, I'll highlight it. But if I say traditional, it could be a 401k plan or it could be a traditional IRA. So let's start by asking which one is right for you. Traditional accounts oftentimes don't even have the word traditional in them. So we oftentimes refer to things like a 401k or an IRA, and we don't use the word traditional. And that's because these are the original types of retirement accounts. It wasn't until later that Roth accounts came by. So Roth accounts always have the name Roth in them, but traditional accounts don't always have the name traditional. But the way traditional accounts work is they're funded with pre-tax dollars. So if you're at a place of employment, the money comes out of your paycheck before taxes are taken out. And what that does is it lowers your tax bill in the current year. Now, one of my rules that I like to quote is that the IRS never forgets. So if you get a tax break in the beginning when you put your money into the IRA, the flip side is that the IRS is going to tax those withdrawals when you take the money out. Now, additionally, there's a limiting age, which is currently age 73, but will later go up to age 75 for those born in 1960 or later, which requires you to take a certain minimum amount out of the account. And the reason for this is because in a traditional account, you're getting the tax deferral. So from the time you deposit the money until the time of withdrawal, all that money is growing without taxes coming due. What do we know about the government? They need money. And essentially by age 73, they say, we're tired of waiting for you to take a withdrawal. Therefore, we're going to require you to make those required minimum distributions from the account, which produces income to you and therefore taxes. Now compare that to a Roth account. In a Roth account, you're funding it with after-tax dollars. Therefore, no current break for income tax purposes. But because you have the contributions made on a after-tax basis, when you go to take the money out, those withdrawals are going to be generally tax-free. Additionally, because there's no tax generated by the withdrawals, the government has no incentive in forcing you to take those withdrawals. So there's no required minimum distributions in a Roth. Now I'm going to get a little bit technical on you here, but I promise we're going to get to the good stuff, the strategies, in a moment. Each year, there's a limit that's set for how much you can contribute to these plans. So at the place of employment, whether it be a 401k, a 403b, or for government employees, a thrift savings plan, if you're under age 50, you can contribute in 2023 up to $22,500 of your income into the plan. If you're over age 50, you can make what's called an additional catch-up contribution of $7,500, meaning that you could contribute a total of $30,000. In an IRA, an individual retirement account, the limit is $6,500 and $1,000 respectively. Now, all these numbers have a further limitation that you must have that much money in earned income. So if you only make $25,000, you cannot contribute $30,000 to your 401k plan. Now, once you meet the company eligibility requirement, and a lot of times you may have to wait an entire year before you become eligible for a company-sponsored retirement account, you can then contribute to either the traditional side, the Roth side or contribute to both of them. So we'll keep using that example, someone over age 50, because 30,000 is a nice, easy number to remember. That means I could contribute $30,000 on a pre-tax basis to my 401k plan. I could contribute up to $30,000 on an after-tax basis to the Roth side, or I could split that up and say contribute $15,000 to each. Not all plans have Roth options, but all plans do have the pre-tax traditional. Okay, so if your plan does not have a Roth option, you can only make use of the one. Now let's switch over to the individual side. In a traditional IRA, anybody can contribute to a traditional IRA, assuming that you have earned income. However, not everybody can get a tax deduction for it. So your tax deductibility is going to be based on whether or not you and or your spouse has a retirement plan at work and how much your modified adjusted gross income is. And again, just bear with me because I know I'm going through a lot of numbers and relatively quickly here. I just want to make sure we have the basics before we get into the strategies. So if neither you nor your spouse has a retirement plan at work, you can contribute up to the $6,500 if you're under age 50 or $7,500 if you're over age 50 to a traditional IRA and get a full tax deduction for your contribution. Period. If you have a retirement plan at work or your spouse has a retirement plan at work, then it's subject to income limitations. And here's where it's going to get a little complicated. I'm not going to walk you through the entire slide. I'll just leave it up long enough that you can look and see where you would fall on the slide here. But if you're single, suffice to say, if you make more than $83,000 of modified adjusted gross income, you cannot take a tax deduction for a contribution into your IRA. If you're married filing jointly and you make more than $136,000, then you cannot take a tax deduction for a contribution into your IRA if there is a retirement plan at work for you or your spouse. Roth IRAs have their own set of rules, and it would be nice if these were all consistent, but of course that would be asking for a lot to make the tax code simple. Contributions to a Roth IRA are simply limited whether based on your modified adjusted gross income. It doesn't matter whether you have a pension plan available to you at work. With Roth IRAs, it is a hard maximum. So if you're single and you make more than $153,000, you cannot contribute to a Roth IRA. So if you remember the previous slide, I said you cannot deduct your contribution to a traditional IRA, but you could still make the contribution. Here in a Roth IRA, if you make over the limit, you cannot even make the contribution. If you're married filing jointly, the limit is $228,000. Okay, enough of the mundane. Let's get into the good stuff. Let's talk about the different strategies using these different types of accounts. So the first thing we're going to talk about are Roth conversions. A Roth conversion is the idea that you have already put money into a traditional IRA and you decide you'd rather have it in a Roth IRA. Roth conversions are allowed, and there is no income limitation. In other words, you can make $1 million a year and you can still do a Roth conversion. The advantages of doing a Roth conversion is you take the money from the traditional account and move it to the Roth account. Now, what the advantages are is all those advantages that come with the Roth IRA. So we reduce the amount of taxable income in retirement. Okay, so when we take those withdrawals down the road, we're not going to have to pay taxes because we're taking it now out of a Roth account as opposed to a traditional account. Once we get the money into the Roth IRA, because not only is it tax deferred similar to the traditional account, but distributions are tax-free, when the money grows, not only is it the amount I put in, but also that growth that becomes tax-free. So let's say I convert $10,000 and it grows to 15, that extra $5,000 becomes tax-free to me as well. Another advantage in doing a Roth conversion is that I won't be forced during my lifetime to take distributions starting at age 73 or at 75. And finally, Those who inherit that Roth IRA from me receive the money tax-free, so they won't be subject to taxes. So a lot of advantages to being in that Roth. What's the disadvantage? Well, remember, the money went into the traditional IRA before tax, and you're going to make an after-tax contribution to a Roth. What's the missing ingredient? Taxes. So now, to do a conversion, we have to pay tax on the money we move from the traditional IRA into the Roth. Going back to my example, if I do a $10,000 conversion, and for the sake of our example here, we're in a 25% bracket, I can convert $10,000, but I have to pay the tax on that $10,000, which means I need to send the government $2,500 in addition. And to make things worse, if I convert $10,000 and take the $2,500 from the $10,000, now only $7,500 goes into my Roth IRA. So it gets a little bit complicated here, but in certain situations, it's advantageous to do these Roth conversions. Now, we got a question here. Is it likely Congress will end the practice of Roth conversions or start requiring distributions from Roth IRAs? Great question. That one actually comes up a lot. And the answer is actually, if you think through it, is Congress likely to end the practice of Roth conversions? The answer is no. And the reason for that is, what do we have to do to convert into the Roth? We have to pay taxes. So let me rephrase the question. Is Congress likely to say, we don't want your tax dollars today, we'll take them later in the future? No. And ironically, if you think about it, in that traditional account, they would continue to grow and Congress would get a bigger tax payment later, but Congress doesn't think later. Congress is all about taking the tax dollars today. Will they start requiring distributions from Roth IRAs? I have not heard any discussion about that. I don't think they will, because there's no benefit to Congress in doing that. They don't generate any taxes, but I guess it would be possible. I won't say that's not possible.
And in fact, just to chime in here, they went the opposite way, where with a Roth 401k, they actually required minimum distributions from a Roth 401k, and they recently removed that as well. So from a Roth 401k looking forward, that required minimum distribution is not applicable. So it used to be you had to roll it over from a 401k Roth into a Roth IRA in order to not take distributions, and they actually removed that. So now you can leave it in the Roth 401k and not take distributions. So they actually went the opposite way than what your question is saying, requiring those distributions from Roth IRA. So is it possible? Yes. But that's not where Congress is looking currently for their tax dollars, because it really doesn't generate any in that forcing of the money out. It definitely does from traditional accounts where they have those RMDs in place. So yeah, thank you for that question. We also had another one that I answered live as well, just kind of clarifying that, again, the difference between Roth 401k and IRA around the limits, income limits. So for a Roth 401k, just to reiterate, there are no income limits to that, meaning as long as the employer allows you to have access to a Roth, not all employers do, most do now because it's been around for a while, but as long as they offer a Roth, it doesn't matter your income, no limits there, you can contribute. For the Roth IRA, that's where the income limits you need to pay attention to. So they're similar accounts because they're both Roth taxed similarly, but the contributions to them are looked at differently because they're technically different accounts. So thanks for that question as well.
Great, and thank you for that, Justin. Yeah, and if you think about where Congress is going, it's more likely that they're going to be encouraging the use of Roth IRAs and Roth 401ks in the future, because that means they get more tax dollars today. The advantage of the traditional is you get a tax deduction for it. Congress is not looking to give out new tax deductions. They're looking to take away what's already there. Okay, great area of discussion. Now let's get into a second strategy, which is called a backdoor Roth contribution. And if you were following our Shakespeare players earlier, you heard Ophelia talk about the backdoor Roth contribution. A backdoor Roth contribution is a way of getting around that income limit that could prevent you from making a contribution to a Roth IRA. And the way a backdoor Roth contribution, and backdoor is a nickname that has become so well used that people think that's actually the official name, but it's just a nickname. What we do here is we say, all right, if I make above the certain limit, I cannot contribute to my Roth. But I can always contribute to a traditional IRA. Remember, everybody can always contribute to a traditional IRA, assuming they have income. They just may not be able to get a tax deduction for it. So if my income is so high I can't contribute to a Roth IRA, I can contribute to a traditional IRA. I won't get a tax deduction for it, but immediately I go about the process of converting it into a Roth IRA. Now, when I do that conversion, because that was an after-tax contribution, there is no tax due on the amount I contributed. And because I do it immediately, there's no growth. Therefore, if I'm over age 50, I contribute $7,500 to my traditional IRA, convert it into a Roth IRA, and now I just made, through a two-step process, a $7,500 contribution to a Roth IRA, with even though I'm above the income limits. Now, one thing you have to be careful about is the IRS will aggregate all of your traditional IRAs, so that if you do have money in traditional IRAs on a pre-tax basis, and you do this process, when you go to do the conversion, it will not be tax-free, because the IRS is going to say you have these other IRAs that we have to count in there as well. So you have to do a little bit of planning work on this one, but it is a way to get money into a Roth IRA if you're above the income limits.
And again, just to reiterate, that is specific to the IRA, meaning if you have traditional 401k or 403b or TSP, that is not included in the calculation. Only IRAs, so traditional IRAs, SEP IRAs, simple IRAs would be. So you need to look out for if it has an IRA, that would be included and kind of make that backdoor Roth more difficult and taxable. But if you have 401ks or other types of employer-sponsored plans that aren't an IRA, then that does not get included in the calculation. You're still able to do it.
Thank you. All right, next strategy we're going to talk about is asset placement. And our firm does a lot of work on this area of asset placement, but we find a lot of people have never even heard of this concept. Asset placement is the idea that not all things that you invest in generate the same level of taxation. So, for example, many of you know that if you purchase a bond pays you interest. That interest is going to be taxable to you, assuming it's not a municipal bond. So, for example, if I buy a bond that pays 5% interest, that interest, just like my bank account, is going to be taxable income to me, and I have to pay income tax on that at an ordinary income rate, which is the higher of the income tax rates. Okay. And it's going to be based upon my income, my income bracket, but I'm going to be paying it at an ordinary income rate. Therefore, assets that generate high taxable income, we don't want to have them in accounts that that are going to pay taxes. We'd rather those types of assets end up in tax deferred accounts, because that high tax burden will not have to be paid. Conversely, other types of assets generate what's called capital gains. Capital gains are when you're taxed on the appreciation of an investment, but not the income flow. Think of a stock that you bought 10 years ago. You hold that stock for 10 years, paying no taxes on it, and it's not until the day you sell it that you have to pay capital gains tax on the growth of that stock during that 10-year period of time. Capital gains taxes are lower than ordinary income taxes. Therefore, we want to take those assets that are going to generate capital gains and have them taxed to us in a taxable account, because we'll be paying that lower rate. If we put that same asset into an IRA, when we take the money out of the IRA, we're going to have to pay the higher ordinary income tax rate. So real simply put, we take the assets that generate high taxes and we put them in a tax deferred account. We take the assets that generate low taxes and put them into the taxable account. Finally, if we have a particular asset that we think has a higher expected rate of return, this might be small company stock. This could be perhaps stock of companies based in emerging markets. We're going to take those types of assets and put them into the tax-free type of account, the Roth account, because then we never have to pay tax on the growth. So it's not enough to say in the old days where we would diversify account and we buy stocks and bonds and large companies and small companies and domestic and foreign, and we'd hold that over here, then we hold that over here, then we hold that over here. Instead, we're going to segregate those assets and put them into the proper taxable account in order for you to pay the lowest tax burden. Same investments, but placed in different accounts. Next strategy, most of you have heard me either talk about or write to you about, particularly if you're over the age of 70 and a half, because that's the age at when you're able to make what's called a qualified charitable distribution. You'll oftentimes see the acronym QCD, Qualified Charitable Distribution. And what a qualified charitable distribution allows you to do is to take money from your traditional IRA. And again, this is not your 401k plan at work or your 403b. It has to be an IRA. But from your traditional IRA, remember this is pre-tax money, and we can send that pre-tax money to a charity directly without incurring any taxes. The advantage of doing a QCD is that for those taxpayers, which is going to be most of us now, who do not itemize our deductions, you just take that standard deduction. Charitable contributions are deductible as an itemized deduction. If we don't itemize our deduction, we don't get a deduction for giving to a charity. By doing a qualified charitable distribution, we're sending pre-tax money to the charity, who of course does not have to pay taxes on it. So the advantages of doing a QCD is that these distributions do count towards your required minimum distribution. So it reduces the amount that you're going to have to take out and pay taxes on when you reach age 73. And your charitable donations reduce your income tax burden because you're not going to have to take that distribution from the IRA and pay taxes on it down the road. I mean, the best way to perhaps understand this is for me to give it an example. If I want to make a $1,000 contribution to a charity and I don't use a qualified charitable distribution, and let's say I'm in a 20% tax bracket, how much money do I have to take from my IRA? Well, I'm going to have to take $1,200, $1,000 to give to the charity, and $200 to give to the government for my taxes. But if I do a qualified charitable distribution, I can take $1,000 from my IRA, send it to the charity, they get the same amount of money. Who gets cut out of the deal? The government. And I don't know about you, but the government's my least favorite charity. Next strategy we're going to talk about is what we call tax crunch. And the tax crunch refers to people who delay taking distributions from taxable accounts because they want to wait to pay the taxes. They're told they're going to pay a lower tax rate when they retire. And that might be true, that you'll be paying a lower tax rate. But a lot of retirees can tell you taxes don't necessarily go down just because you retire. So if we take a look at something like an IRA account, traditional IRA account, or a traditional 401k account, we have to take this money out. We could delay taking the money out until later and later and later, potentially as late as age 73 currently, and 75 for those over who were born later than 1960. But the fewer years I take the distributions out, the more I have to take out each year. And the more I take out each year, potentially pushes me into a higher tax bracket. So by spreading my distributions over more years, I could be taking out less and avoiding going into that next higher tax bracket. Keep in mind that in 2026, the current income tax law that we're under will sunset and will return to a set of tax brackets that are higher than they are currently, which would mean that you're going to be paying a higher percentage of a bigger distribution to the tax man. And my elementary math teacher told me a bigger number multiplied by a bigger number means I'm paying more in taxes. All right.
Before we move on to this slide, I just want to circle back to the QCD. We had a question come in about still claiming a donation on the taxes. So first, QCDs, you have to be 70 and a half in order to be eligible for them. So something that I couldn't do, I couldn't take money out to give to a charity now. I have to wait till 70 and a half, and you don't get to claim the donation on your taxes. What happens is you just don't have to claim the income. So if you were to take it out of a traditional IRA, you would first have to claim that as income, pay taxes on it, and then you could give what's left over to the charity. The beauty of the QCD is that you don't have to claim it as income. It goes directly from the traditional IRA to the charity, you don't pay taxes on that distribution. The charity doesn't pay taxes, so everybody's good. So you don't get an extra double deduction for then taking the money off of on your taxes. You just get the break of not having to pay taxes on that specific distribution.
I like that concept, double deduction. I don't know if we can get that one through Congress, but it sounds pretty good. So with that, let's talk a little bit about some tax planning considerations that come into play when we talk about these retirement accounts. So anybody on the webinar here who's over age 65 is probably familiar with the acronym IRMAA, typically pronounced IRMA, which is an income-related monthly adjustment amount. And usually that's a five-word curse, because what it means is that the government's going to charge you extra for your Medicare Part B premiums because you make over a certain threshold. And the more over that threshold you make, the bigger that income-related monthly adjustment amount might be. This becomes important because the more we have to take out of our retirement accounts on a taxable basis, think traditional accounts, the more we have to take out of our traditional accounts on a taxable basis, the further it's going to push us up the scale of having to pay more in Medicare Part B premiums. So you could have two people taking out the same amount of money from their retirement accounts, and one has to pay higher Part B premiums than another simply because one's taking it from a traditional account and one is taking it from a Roth account. So when we're younger, we all love the attraction of the traditional accounts and getting the tax deduction. When we're older, we all love the tax-free income that Roth accounts produce in retirement. The second tax concept we talk about is tax capacity. Tax capacity means how much more income can you take in a given year in your current tax bracket before you're pushed into the next higher tax bracket. So we know what your taxes are going to be for this year. We know what your marginal tax rate is. And if we can take out more income and only pay the same marginal rate that you're paying right now, that might avoid having to pay a higher marginal rate down the road. Similar concept is with capital gains. In capital gains are taxed at 3 different rates at the federal level. They're at 0, they're at 15, or they're at 20. Imagine you're in a 0% bracket. If you're in a 0% bracket, wouldn't you like to pay more taxes, have more gains rather, subject to taxes at 0%? Sure you would. You would look to take the maximum amount of gains you could without leaving that 0% bracket. But for many people, they will be in the 0% bracket, leave gains for a future year, and then that future year, they might be in that 15% or 20% bracket. So capital gains tax capacity says, how much more can I take in gains before I go to the next bracket? And the final tax plan consideration I'm going to mention here when we're talking about the idea of Roth and traditional is the idea of legacy. Because as I mentioned earlier, the IRS never forgets. So if you have an account that the money went in on a pre-tax basis, somebody is going to be paying that tax bill. If you die, that tax bill being unpaid, it will be your beneficiary who pays that tax bill. So the question becomes, do I want to leave my beneficiaries taxable assets or tax-free assets? Now, if I'm leaving the money to my spouse will be able to inherit this money and continue to take distributions over the course of his or her lifetime. But if I leave it to a non-spouse, they only have 10 years to take out all of the money from these accounts. Let's take the example of a very large inheritance. Let's assume you inherit $1 million in an IRA account. Well, if I wait the entire 10 years to take the money out, and let's make it simple here and assume that you don't have to take anything out for the first 9 years and that you don't have any growth. So in 10 years, you have an account that's worth $1 million. Okay. That idea of tax crunch. I got $1 million. I have to take it out in that 10th year. What tax bracket are you going to be in if you have $1 million of income? You're going to be in the top tax bracket. So you've taken your $1 million and you subject it to the highest tax rate by deferring. What if I take out $100,000 per year for each of those 10 years? Well, now I could be in a higher tax bracket for all 10 years. Maybe not as high as the $1 million one, but I'll be paying more on all my income for 10 years. So this idea of legacy and planning this out over the distribution becomes really important. It's not just, you'd like to say it's just as simple as trying to figure out when do I pay my taxes. It's a little bit more complicated than that. So hopefully I haven't overly confused you, but here's a couple things that I'll summarize with. Number one, don't go it alone. Obviously, this stuff is complicated. I mean, I have slides up here and I'm looking at the numbers, and that's why I'm able to tell you all the different strategies and numbers and ways we do things. But if you try to do it alone, chances are you're going to miss one of these slides. You're going to miss one of these ideas. And as expensive as it is to hire a good accountant, as expensive as it might be to work with a financial advisor, the mistake that you make is probably going to be much more expensive than the cost of working with a professional. Number two, tax and financial planning is a team sport. We like to work with tax professionals with our clients because we know the planning work that we do is going to affect the work that they do. And conversely, the work they do is going to affect the work that we do. If we work in silos, if we work in isolation, the odds of you having as good an experience as working on a team basis is remote. Finally, there's a myriad of rules and numbers. Don't get all caught up in the details. Worry about the concepts. Worry about what you're trying to accomplish, and then let the professionals walk you through all the numbers and rules and all the different things that you might run into. And with that, we'll now begin a review of these different options. And I'm going to return to our Shakespearean theme and conclude by saying, "Hark, good sirs and gentle ladies, lend me thine ears, as I regale thee with a summation of retirement plans, both traditional and Roth. These noble vessels for thy goal, where retirement dreams may dwell. Let us commence with a traditional IRA, a time-honored choice, where contributions thou maketh with a pre-tax voice. In the realm of taxes, 'tis a boon, for 'tis a deduction true. Reducing thy income, a privilege thou shalt pursue. Yet when the sands of time shift and retirement draws nigh, withdrawals from thy traditional IRA must heed the tax man's cry. For in that hour, the kingdom's coffers must be fed, taxed as ordinary income, as if labor's toil it be led. But lo, enter the Roth IRA, a different path to tread. Contributions made with after-tax coins for thy earned bled. No deduction granted at the present, but listen, bearing clear. When the time of retirement arrives, a joyful sound thou shalt hear. For when the golden hour strikes and thou needeth wealth to sustain, withdrawals from thy Roth IRA with no tax stain. Like a rose untainted by the sun's scorching ray, no taxes on thy earnings, forsooth, they shall stay. To choose between these options, a decision for thee to make. Consider thy circumstances and ponder the path thou shalt take. If thou seekest to lessen taxes now, the traditional way may shine. But if tax-free withdrawals and retirement beckon, the Roth shall be mine. So weigh the scales, consult thy wise advisor near. For in the realm of IRAs, each choice doth hold a different cheer. Traditional or Roth, a question that thou must ask to secure a prosperous future and complete thy financial task. And with that, Justin, I will return you and see if there's any final questions before we wrap up.
Oh man, if the task was if we could make Shakespeare even more complicated, I think we've done it by combining Shakespeare into finance. That yes, absolutely incredible. If somebody really understood that, you definitely got today, because you're a Shakespearean expert and you're a financial expert now. Definitely listen to that 5 times and you might get all of that was in there. Thank you so much, David, for the wonderful presentation and the Shakespearean recap as well. If you like this webinar, we do these every month, and we've got a lineup coming up of multiple webinars on the first Wednesday of every month. Coming up July, August, and September. July, we'll be talking about taxes, how to maximize your tax savings. Hopefully you've gotten your taxes completed for last year. If you haven't, you might be on extension, but there's nothing you can do about those taxes now. They're already paid and done. But there may be something that you can do for your 2023 taxes. And, addressing it now versus at tax time next year is going to be able to have you get the best benefit that you can. August, we're going to be talking, and that's July 5th at noon. Wednesday, August 2nd at noon as well. We're going to be talking about Social Security. Social Security, we're going to be giving updates there, different claiming strategies available. Most people take it too early and rob themselves of a benefit into the future. So definitely be talking about Social Security there. And then Wednesday, September 6th at noon, navigating Medicare. So that's right around the time of open enrollment, or if you're approaching age 65, you definitely want to pay attention to Medicare and what all the rules surrounding that are. And so you'll want to sign up for that. They're not available just quite yet, but they will be available to register on our website, personalwealthstrategies.com. You click on events, upcoming webinars, and you'll be able to sign up for those as well. Also, thank you for registering for this. You will get a recording of this webinar once it's available. And we look forward to having you at future webinars. If you have any specific questions about your situation on anything Roth or not to Roth, you can feel free to contact us here at Personal Wealth Strategies. Our phone number is 609-586-9308. And you should have our emails as well from the website, personalwealthstrategies.com. Thank you so much. David, any final from you?
No, we just had some fun with a complex idea, but really everyone's situation is different. But these different strategies are all out there for the taking. You either use them or you don't. We recommend using them.
Yes, if you just want to pay more in taxes than you have to, then don't worry about it. Yeah, that's fine. Don't use them.
That's my advice.
All right. Thank you so much, David. Thank you for the attendees for sticking around, and we look forward to seeing you next time.